Welcome to a special webinar from CPG Matters. I'm your host, John Karolevsky. Thank you for joining us. In this webinar, you will learn how marketing and finance departments can take a forward-facing approach to their antiquated marketing mix analysis. Our speaker is Greg Dolan, CEO of Keen Decision Systems. But first, here are some housekeeping items. Attendees are in a listen-only mode, but this conference is interactive. If you have questions, and we encourage questions, type them in the chat box in the lower right of your screen. We'll answer them along the way or at the end as time allows. Now, this webinar is being recorded. All attendees will receive a link to this webinar. So, without further ado, I will turn the microphone over to Greg Dolan. Greg, the podium is yours.
Thanks, John. Really appreciate it. And it's great to be with everybody. I appreciate the opportunity to share more about Keen and the approach that we're taking, the new approach that we're taking to next generation marketing mix. So by way of background and introduction, I am a CPG veteran. So I actually started my career in the food industry back in the late 90s. Worked at Kraft Foods and then Campbell Soup Company for 7 years. And as part of that, more of a general management approach with P&L ownership, I was responsible for the financial outcomes of the brands that I managed. And my one big lever that I had at my disposal to drive performance financially on my brands was marketing. And unfortunately, as I came up through the ranks in CPG, I didn't have the data or the information necessary to make timely decisions. So I had traditional marketing mix that I utilized that gave me a great perspective on the last 2 years and gave me a report card of how my brand had performed over the last couple of years. What it didn't do is give me the information that I needed to adapt to the marketplace, be agile, and make my next decision. And that was really the impetus for starting Keen back in 2010. So we're really focused on reframing the challenge that marketers are facing from strictly a historical measurement perspective that often takes months of data collection to get to a 200-page PowerPoint deck, to providing marketers with information at their fingertips that allow them to make the next decision that drives their financial results, that's accountable to the outcomes that they're being held responsible for. So that's really where Keen comes into play. So Keen is a marketing measurement solution that really informs future planning and decision-making. It's delivered through software, and it really leverages information that's accessible in real time that can be updated with the speed of data availability. So we take in information as it becomes available. The algorithms in our software allow you to quickly take that information in, append data to the existing data set, leverage the full knowledge estate comprehensively across your entire marketing mix. So it's an omni-channel solution that's incorporating all of your offline data, all of your online channels, your retail media and trade, incorporating all those external variables, competitive activity, seasonality, and all of those pieces to get to the right answer. So how am I performing today versus yesterday, and what does that mean for tomorrow? So we provide this through a Bayesian approach. So I talk about leveraging the full knowledge estate. One of the unique aspects of our application is that we're able to take in all information. We have a proprietary patented market elasticity engine, which is populated with Bayesian priors. So we have about 40 years of academic research, as well as 13 years of metadata, elasticities from every channel imaginable across categories, brands, industries, as well as geographies. And that becomes a starting point for our models. So automatically, we're bringing the best industry knowledge to bear to the problem. We're then layering in all of the other analytics and data that's available to the marketer. So whether that's previous marketing mix or MTA or lift studies, A/B tests, all of that information can be used to adjust our elasticities with that information. Then we're layering the time series data, GRPs, clicks, impressions, and that full knowledge estate is developing a more predictive, more prescriptive model that provides marketers with response curves into the future that allows them to identify the point of diminishing returns, the marginal ROI of each incremental investment, and get to an answer that they know and have confidence can deliver the financial results. And all of this is done through data integrations and and an algorithm that's updated automatically so it can be fast, iterative, and accessible through software. So why is this all necessary? Because the market has evolved. In the past, when I started my career in the late '90s, we could see that there was minimal complexity. We thought it was a lot more complex than it was at the time. We know now with hindsight that it could get a lot more complex and fragmented. But essentially, we're deciding between traditional channels, network TV, radio, print, out of home. How do I really think about my marketing? It was more of a, set it and forget it. I'm going to plan and I'm going to execute the plan. I'm going to buy a lot. I'm going to commit to a lot of my dollars up front. And then I'm going to hope that the assumptions that we made around those planning decisions are going to be right. And they're going to help me to deliver the financial results we're being held accountable for. That quickly changed in the early 2000s as digital started to emerge, right? So we had digital channels, and all of a sudden we have to take our tried and true TV spend and start to allocate more dollars to relatively unknown digital channels. And that's where kind of a traditional marketing mix approach shifted to attribution. So from top down to bottom up. That became even more complex in the 2010s as we started seeing more online direct-to-consumer e-commerce business. I call it digital 2.0. MTA became the primary source for understanding marketing performance. Again, it was bottom up. But what this pendulum swing from traditional marketing mix back in the late 90s to attribution MTA in the 2000s did was it ignored a lot of the offline channels. So you still weren't being able to account for those offline channels, those other activities that may be impacting your financial results. And honestly, it wasn't connected to both the short term and the long term. So understanding what kind of impact marketing was having on the long term impact on your business, how it's building equity over time. And then to make it even more complex, we're now into the roaring 20s where we have retail media networks. We have more complexity, more fragmentation, emerging social media platforms, new tactics that are available to marketers, and they now have thousands of decisions to make in a really highly complex world, and they have to do it much quicker than they have in the past. So really impossible to do without some kind of data aggregation, data organization, and a technology solution to help decision making. And then what happens if the world changes? So we've seen this all in the last couple of years. So again, in the past where you had a marketing mix study that informed a plan, you set it and forget it, and then hopefully that plan delivered against the financial results. Didn't account at all for changes in the marketplace, whether that's a 100-year pandemic, inflation challenges that impact your gross margins, supply chain disruption, which keeps your products from getting on shelf, and any competitive changes. So if you have a certain assumption around how your competitor is going to behave, whether that's spending or launch activity, and that changes overnight, that obviously impacts the way that you need to support your business to stay competitive and be effective, and to be able to achieve those financial results that you're being held accountable for. So your marketing plan is essentially obsolete. So sometimes I think about this as focusing a camera. So you focus the camera, you're ready to take the picture, and all of a sudden the object that you're taking a picture of moves, or something changes in the environment, and you have to refocus. And it's no different than what a marketer faces now in this rapidly changing, very fragmented world that's moving very quickly. I could say that I've been there. So if I go back into a real use case of my time as a brand marketer in the CPG world, I was running the V8 brand for a time at Campbell's. I had spent about a year repositioning the brand at the time, developing a new omni-channel campaign with my agency partners. We launched that campaign, and as luck would have it, the Great Recession happened about 4 weeks after we launched the campaign. The challenge is that we didn't have any information at that point to adapt to that, or to incorporate that information into a model that would allow us to then change our assumptions and potentially change the plan that we were implementing in the market. The problem with the Great Recession is that we saw disposable income disappear overnight, and suddenly consumers weren't interested in buying $4 juice. So we had to adapt. We had to make changes. And with the lack of any information around how the campaign was performing in the short term, early reads on impact, the decisions were made to, as what happens in most cases when you're without the information necessary to make a decision, it's reallocated to price promotion and deeper discounts to drive purchase at the shelf. That obviously came at the trade-off there was it came at the expense of continuing to build long-term value during a difficult macroeconomic period. And we know that focusing on the bottom of the funnel and not considering the brand building and base building activities that happen at the top of the funnel become much more expensive over time. So that is really the use case for why a real-time next generation marketing optimization solution is necessary. So what do you do if you're facing challenging decisions? So how do you make sure that you're allocating every single dollar based on the most positive financial outcome that you can achieve, right? So if I need to hit a revenue target or a long-term value target, how do I make sure that every dollar is working as hard as possible against those goals? How do I understand how marketing performance, how ROIs, what kind of ROIs we're achieving across our marketing mix, across time as well? So are we investing in the right tactics at the right time? How do we drive decisions? So if we're thinking about optimizations without an understanding of the expected financial outcome that you're looking to achieve, it's very difficult to land on the right mix and the right timing for your investment. So, where do I invest my next dollar to get the greatest return? So we advise our clients often not to focus as much. Again, we're trying on the historical performance. Again, we spend about 5 minutes on historical performance. Our job ultimately is to improve that result. So how do I take a 90-cent ROI and make it $1.20 and make sure that every dollar is working as hard as possible on that response curve? And then how do I account for changing landscapes? So the investment profile that you execute for a brand is largely dependent on what's happening externally. So if a 100-year pandemic happens and you're unable to execute in-store promotion and shopper marketing, you have to find an alternative for that spend. So how do you model that out and understand potential impact? And that could go for any external factor, including competitive activity, inflation, supply chain challenges. How do I understand, based on those external environmental factors or changes in the marketplace, how do I understand what the right amount of spend is behind the brand? So again, if you're facing those challenges and you can't get product on shelf, you may not need to spend as much. And there's wasted spend by overspending given that situation. And then where do I decide to invest as new channels and new potential media options become available? So retail media is a great example of this. We see this with all of our clients where there's a fixed budget, and with the challenging market environment that we have, those budgets aren't getting bigger. In fact, they're getting smaller. And given the fragmentation we just talked about, they're being spread across more channels. What happened? And sometimes they're new channels. So how do I quickly understand and estimate the impact of these new channels, allocate the right amount of spend, and validate that that's the right amount of spend behind those new channels? And then most importantly, quickly learn from the experience that we have in investing in those new channels. So we do this often with our clients, and because we have a Bayesian approach and we can estimate impact without any historical data, we can go in and introduce a new tactic like TikTok or some other new media vehicle, and then quickly learn from that. So we have an initial investment that we make, and then 4 weeks later, as we update the model, we're getting an early read on whether that return is going to be higher or lower than expected. And the system will learn from that and then allocate appropriately looking forward from there. So why is this important? Well, one, I've been in this industry for over 20 years, and we haven't seen a whole lot of progress in terms of how marketers are tracking performance. As I mentioned before, we went from kind of top-down traditional marketing mix to attribution. Now we're coming back to more of an omni-channel unified approach, which I think makes sense, but still adoption isn't where we need it to be. And this chart kind of blew my mind in the fact that 70% of CMOs are still using Excel and PowerPoint, traditional approaches to measure impact. That's just not sufficient in terms of how quickly the market's moving and how fragmented and complex the market is. So you need some kind of uh, data aggregation, data organization fed into software to help drive the necessary speed of decision making and understanding of performance in real time. At the same time, we know, as we just talked about, there's increasing pressure to drive results for the marketer. I think one of the big problems that I've witnessed over many years in the industry is that, marketers are often talking a different language than the rest of the C-suite. So as marketers, we talk a lot about, traditional marketing KPIs. What's my awareness? What's my brand equity? Where are my brand equity measures? In reality, the CFO, the CEO, and the rest of the C-suite talk in a different language, and that's dollars and cents. So there's always been this marketing proof gap and this language gap between marketing and the rest of the C-suite. And what we do at Keen, and our mission is really to drive, to demonstrate the connection between marketing and driving shareholder value. And that's ultimately what marketers are being asked to do. So with the pressure macroeconomically, particularly on the CPG industry, every single dollar is being scrutinized. Add that to the complexity of trying to make decisions with a smaller budget across more channels on a shorter time frame, and you could see the opportunity and the need for solutions that could provide this answer with a lot of confidence and certainty, and provide the confidence for the next decision as well. So here again, only 34% of CMOs could provide a marketing ROI when asked, and there's obviously pressure on the CMO to be able to do that, demonstrate that, but it also creates a huge opportunity for the CMO and the marketing department in general to be able to speak the same language, demonstrate what we all know, and that's that marketing can drive financial performance, do it profitably, and then build value over time. Again, another chart just to demonstrate how challenging the environment is and how dynamic it is, and the fact that strictly historical measurement cannot inform the next decision and do so in a predictive and prescriptive way. So just looking at some of the spending shifts that we've seen, and this shouldn't be news to anyone on this webinar, is that we've seen dramatic shifts between channels. So brick and mortar versus e-com. We've seen spending shifts. As we can see here, there's a 49% increase in allocation to native ads versus 2021. We've seen a 74% decrease in Facebook advertising since 2021. So these wild shifts present challenges by leveraging strictly historical information to make decisions. So we need to be able to leverage the best information possible, account for these changes, and then learn quickly. And the only way to do that is through adaptive learning. So iteration, being able to ingest data quickly, analyze it quickly, and understand how these shifts are impacting the business, so in order to inform that next decision. So what does the future look like? I've alluded to it throughout with the introduction to Keen and what the work that we're doing. But essentially, the complexity, the fragmentation, the cost involved in making these decisions really necessitates a shift in the delivery model. So we can't wait 6 months for a custom bespoke analysis that gives us a perspective on the past. SaaS and our platform is a software solution is built on repeatability and scalability. So once the model is set up and implemented, all you need to do is append new data, click a button, and you essentially have a new marketing mix with adjusted elasticities and an ability to from there make decisions, which is the next point. It isn't necessarily about historical measurement, although measurement is important. It doesn't pay the bills. So ultimately, you need to inform the next decision, and that information that you have and intelligence that you have has to be able to inform a decision that you can be that you can hold accountable, right? So how do I make a decision that's going to help me with confidence achieve the financial outcomes that I'm looking to achieve? Again, be able to speak the same language as the rest of the C-suite, the rest of the organization, and start to translate the work that we're doing on the marketing side, the investments that we're making in driving profitable consumer demand directly to the shareholder value that Wall Street's looking for. And then finally, just the speed. And I think this is an outcome again of the delivery mechanism, the algorithms, and the scalability and repeatability of our process. You need to be able to learn quickly and be agile. And organizations need to be set up to be able to take advantage of this. Of course, data is always going to be the biggest challenge that we all face. But as data becomes more and more organized, and can be ingested into systems like ours, there's an opportunity to drive speed to insight that again can help with the understanding of what's driving our business, and then how do we make changes going forward to drive continuous improvement. So in the end, the world has changed. The marketplace is completely different, has transformed over the last 20 years. As a result, we have to, as marketers, adjust to that and also evolve to make sure that we're leveraging the information that's already available and doing so in a way that helps to connect the work that we're doing directly to the value that we're creating in the marketplace.
Okay, Greg, we've had some questions come in here. Let me shoot some over to you. Number one, how can you adjust the annual planning process with how fast the markets have been changing over the past few years?
So again, I talked a little bit about the past, set it and forget it. So there's always an annual budgeting timeframe, and that should be the starting point. And we often work with our clients on a decision calendar. So when are you locking in your budget? How do we make sure that we're getting information in a way that's informing that budget and connecting it to the financial outcomes that you're being held accountable for on that budget? But then set up a cadence of updates associated with learning quickly and being able to adjust the forecast based on how the marketplace unfolds. So a lot of times we're working with clients on a quarterly basis. A best case scenario would be we're updating models on a monthly basis with new information, and that's feeding any adjustments to their marketing plan. So working directly with a brand's agencies to make any adjustments to spending that's available to be optimized. But then also tying that back to the forecast for the brand. So every scenario that we run within our system provides both a top line revenue and bottom line profit forecast. And we're able to actualize that relative to the previous forecast, right? So we can show the return on investment in our system coming from the optimization scenarios and results that are coming out of it. So a best case scenario is that we're constantly updating every month, every quarter, adjusting with the new information, how the marketplace is unfolding, and then optimizing and reforecasting the business.
Okay, another question. Does Keen offer tailored solutions for startup or emerging brands with little historical data and smaller budgets?
We do, and one of the great benefits of software versus more of a managed services consulting project, which is cost prohibitive, is that the software is efficient enough to support smaller brands that aren't as data rich. So the Bayesian approach that we have that leverages the best industry information available, along with any information that's available from the brand, and that could be limited, gives us the ability to actually run a model at that level. So we have a number of clients that spend under $1 million in marketing annually, all the way up to obviously $1 billion plus. But the efficiency of the software, the fact that it's not we don't need all of the data at a granular level to be able to run models, given the Bayesian approach, allows us to service more of the market and provide guidance around decision making for even the smallest brands.
Okay, another question. Many people are still using PowerPoint and Excel for analysis. Why is that?
I think it's comfortable, right? So I grew up in that world where I'm still using PowerPoint. But I think that there's a belief in the past that we need an external consultant to tell us how we're doing. In reality, we need the data to be analyzed in a way that drives decision making at the speed of the market, and that's what software provides. So you can always develop a PowerPoint deck or download a spreadsheet from our application and utilize that. But really, what's most important are the insights. So, am I leveraging information that's giving me information around how my business is performing, and more importantly, how do I leverage that information to make a decision that's going to improve my business? And that's really the big difference in trying to get marketers out of their comfort zone to change and to be able to adopt this new technology and new approaches. I think is going to ultimately unlock the opportunity for brands in the future.
Okay, another question. Do you leverage loyalty card data in any of your modeling?
So we don't necessarily leverage loyalty card data. We could use it to inform priors. So if, as an example, if there's if we're modeling, say, a consumer segment, we can actually model at the consumer segment level. If we get that information, we could segment to the loyalty card group of consumers, or we can utilize the information as an external variable to say, how does loyalty card uh, either loyalty card acquisition or the existence of a loyalty card program impact the business, but it doesn't necessarily have a huge impact on the way that we're doing things.
Okay. One more. How do you balance the speed that digital networks provide with traditional spends like TV that takes much longer to set up and implement?
So we believe in an iterative approach, right? So any information that's coming into the model uh, is informative, right? It's going to inform the next decision, and all data comes in at on different time lags, right, and different time frames. So digital is going to come in much quicker. As an example, if we're updating a model, we have the planned information. We know we're going to get the digital data faster than we will the updated TV data. We will use planned TV GRPs in the model and then update with the actuals from digital. And we'll still be able to evolve the model based on that new information that's coming from the digital world. Again, that's going to give the marketer the best information at that point in time to make that next decision, particularly around the digital. When the TV data comes in, we'll then, from an iterative process, incorporate that new TV data along with the new digital data and continuously update the models. So it is really about the agility and updating the models at the speed of data availability, and that obviously happens at different in different cadences across the marketing mix.
Okay, that's all the questions I see that have come in. For more information on this topic, and if the attendees have any more questions, please contact Greg directly. His contact information is on the screen, greg.dolan at keends.com. Thank you, Greg. That was great.
Thanks, John. Really appreciate the opportunity.
And that brings us to the end of this special webinar. I thank all of you for joining us. Happy trails to you until we meet again.